Hey everyone, it's Aaron. The world of decentralized finance is in peril. This is because Coinbase, which had announced a really cool product just a few weeks ago called Lend, that was going to allow you, a crypto holder, to be able to lend out your cryptocurrency and get a 4% yield every year. Not only is this phenomenally more than any bank account, but the idea for it to be in essence, a risk-free return because Coinbase was going to guarantee the principal that you contributed via a stablecoin. This was going to be basically a no-brainer, and I think we've attracted a lot of attention and a lot of dollars. But unfortunately, this new era of decentralized finance is something that Lend product would really be indicative of, is now under threat by the SEC. The SEC has just issued a Wells notice a few weeks ago to Coinbase over this product, and they say it's a security and you have to go through a lot more hoops. But unfortunately, they're not being told what kind of hoops specifically in order to get it done. And now Coinbase has unfortunately decided to shelve this product and no longer pursue it. This is a big blow to decentralized finance, but in my opinion, it's a temporary setback. However, we have to remain vigilant and show support for these new types of products and strategies that could be beneficial. And I think Coinbase had a very interesting idea, and the way they were pursuing it was a logical and compliant way because they're trying to engage with the SEC preemptively before launching the product, as opposed to other crypto companies that have just started lending and are making money when Coinbase isn't on this type of transaction. So in this video, I'm going to break down more what the product is, but also why I think the SEC is cracking down on this type of product. So go ahead, smash that like button, and when you do, it allows YouTube to show this video to more people like us who want to know obviously what's going on in the crypto world, but what the new opportunities are and ways to earn in the digital economy. Imagine having all of your crypto and not having to sell it for income. If you're a big crypto holder, the opportunity to earn passive income off of your crypto and have it be guaranteed by a reputable company like Coinbase is pretty compelling. So hopefully we haven't seen the last of Coinbase trying for this type of product. So let's dive in. All right, on Bloomberg it says, just today, Coinbase drops crypto lending program plans after the SEC balks at it. So Coinbase is bowing to pressure from US regulators and tabling plans to launch a product that would pay users interest for lending out their tokens. The decision to shelve its lending product, which the company announced quietly in a blog post on Friday, comes after a Securities and Exchange Commission threatened to sue the firm if it moved ahead. It also represents a dramatic reversal for Coinbase, whose top executives made it skirmish with the SEC public in defiant posts on social media on September 7th. Now, Coinbase's about face comes as the SEC under Chair Gary Gensler takes a tougher line on cryptocurrency products that may fall under the agency's purview and the platforms they trade on. The planned Lend program, which would have let users earn 4% by lending their tokens, has become a flashpoint in growing tensions between the regulator and burgeoning crypto industry. So what we see here is it was a super cool product, but the SEC is really cracking down because they're afraid, I think, well, at least what they're saying, is they're afraid that crypto is still this kind of unruly world. There's not a ton of regulation around it, and they don't want investors to get burned. As we continue our work to seek regulatory clarity for the cryptocurrency industry as a whole, we've made the difficult decision not to launch, the firm said. We had hundreds of thousands of customers from across the country sign up and want to thank all of you for your interest. So this is a pretty big bummer. Who is this guy, Gary Gensler, the new SEC chairman, and why would he try and shut an initiative like this down? So in threatening to sue Coinbase, if the exchange lets customers earn interest on their digital tokens, the SEC sent a warning to other firms already offering similar products or contemplating doing so. The move is the clearest sign yet that under Gensler, the regulator will aggressively use its powers to thwart products it's uncomfortable with, even before they launch. And them being uncomfortable with it, cryptocurrency is still very new. And the SEC uses a lot of very dated paradigms. Securities regulation, some of it defined from the 1930s, the 1940s, and it's not really up to date per se, but they like to take a broad application approach to if something is defined as a security, then we have authority over it. Privately, ex-SEC officials said they were shocked by the agency's posture, which Coinbase disclosed on Tuesday. The former officials said the SEC typically waits for firms to start selling investments before announcing possible sanctions, indicating the agency has found a forceful way to shut down cutting-edge crypto offerings it fears are putting consumers at risk. The SEC is being aggressive for the first time in a long time, said James Cox, a professor of Duke University School of Law. The SEC has been putting a lot of muscle into cryptocurrency. It's a big, fast-growing market and a fertile area for abuses. When Gensler took the reins at the SEC in April, many crypto enthusiasts cheered. That's because the former Goldman Sachs Group Incorporated partner knew finance and had taught a class on digital assets at MIT. A background far different than most Washington officials, who had a limiting understanding of this booming market. But that optimism all but faded after Gensler made clear in speeches and congressional testimony that a crackdown was looming. In July, he referred to the industry as the Wild West of our financial system that desperately needs rules of the road. Gensler also said the SEC will step up efforts to hold firms accountable for offering products that may involve securities, including its decentralized financial or DeFi platforms. And again, here, the product in question was Coinbase's Lend product, which promises investors they can earn 4% annually by lending out their USDC virtual tokens. USDC, which is offered by a consortium of firms, including Coinbase, is a stablecoin, a fast-growing corner of the crypto market that allows traders to easily convert their digital assets into cash and vice versa. A stablecoin is almost like a money market account. It just has a stable value, indexed to $1 value, and it doesn't change. It's more of a medium of exchange rather than a way to grow. So that's super important, kind of being that on and off ramp from the world of crypto into cash, dollars, fiat currency. Now, stablecoins have been the focus of intense scrutiny from top U.S. officials this year, including Gensler and Treasury Secretary Janet Yellen. Watchdogs have raised numerous concerns, including that the tokens should probably have registered with regulators so that they adhere to strict investor protection rules. Officials are also worried about crypto firms promising high yields without complying with banking requirements such as deposit insurance. The concern here is that when you don't register something as a security, then it's not subject to some of the rules and disclosures that a security is required to give an investor. The SEC is concerned about if you don't register something as a security, then investors, consumers could get duped very easily. And second, if you're not registering something that sounds like a lending product or a banking product, then there is no way to have a backstop, an insurance for if your funds get wiped out or stolen. Then there's no way for the FDIC to come in and help a consumer. And so this is what the SEC's position is that without these filings and disclosures and clarity of what the product is, there's no way to protect consumers. Now, at heart of the issue, Coinbase is trying to work with the SEC to make sure that they're doing it right. Coinbase's tussle with the SEC became public when Paul Grewal, the company's chief legal officer, said the SEC determined that Lend involved a security, but wouldn't say who or how they reached that conclusion. Grewal added that the agency told Coinbase that if we launch Lend, they intend to sue, prompting the company to shelve the product. And of course, Coinbase CEO Brian Armstrong later tweeted that the SEC was engaging in really sketchy behavior. Despite Coinbase's bewilderment, the SEC has long argued that a range of tokens fall under its jurisdiction. Over the last 4 years, the SEC has consistently asserted that many digital assets are investment contracts or securities based on a legal theory known as the Howey test laid out in the 1940s Supreme Court case. The regulator's stance is that almost anything that gives investors the expectation of profiting from the work of others can be labeled as an investment contract. Unfortunately, the industry has countered that the SEC's view is too vague and unsuitable for virtual coins. So the issue here is, yes, fine, the SEC wants Coinbase to provide clarity. Great, and I think Coinbase wants to do that. However, they're not being given a clear roadmap and path of what the clarity that the SEC needs is. It just seems like they're being stonewalled. And think about this. If you had the ability to get a 4% risk-free rate of return, I think a lot of people would pile into that. If you look at real estate, sometimes a cap rate for a really high-end area could be in that 6% range even, maybe up to 8%. But it comes with a lot of risk, a lot of headaches. So to get 4% risk-free by doing nothing, completely passive, amazing. I remember in 2007, right before the market crashed, I was able to find an HSBC savings account that paid 5.5% interest. It was phenomenal. It's back when interest rates were super high. And then when the market crashed and the Fed had to cut interest rates, then we went into this very low interest rate environment, basically the last 12 years. Actually, sorry, 15 years. And so the opportunity to earn a yield like that, risk-free and passively, sounds super awesome. And I think it would suck a lot of money out of the traditional banking system into these burgeoning DeFi, decentralized finance products. And so is Gary Gensler, yes, he's concerned about investors, but is the SEC also protecting the traditional banking system from DeFi coming in and disrupting it? The fact that you could suddenly have digital transactions, move all your money over, and then you earn money on that without the need for a bank to pay you, and without the entire banking system having all those assets on deposit so that they can lend out for mortgages, personal loans, auto loans, business loans, and then they make a bunch of money. If we shrink the deposits at all the money center banks and put it into DeFi, it's going to hurt them. And it's going to help DeFi. And if you hurt the basic money center banks, I mean, it's so traditional. It's a 100-year-old model. And what's going to happen to them in the future as more money starts to flow towards DeFi, where the consumer has more power, the consumer has more choice, and the consumer has more control, and ultimately, it seems like, could profit more. Now, cryptocurrencies, of course, are still ripe for manipulation and fraud. But a company like Coinbase, which has really seemed like it's done their best to comply with regulators and do things, bring that sort of clarity, transparency, and compliance to crypto, was one of their main advantages as a platform. And now they're trying to do it in a lending product, and the SEC is stopping them. So what do you think? Do you think that DeFi will eventually overcome and the SEC will relent and find a way to provide regulatory scrutiny that is manageable, and we can actually have DeFi products where we can earn really cool interest rates passively on your crypto holdings? Or is the SEC going to continue to block out companies' moves like this and shut down all the lending that happens so that we have to either not do it, or it's going to happen in more shadowy ways, which is going to present a lot more risk to investors? Because there are times where other companies that offer crypto lending, they take your coin, your Bitcoin or whatever, or your stable coin, and they do other things with it. They lend it to other people who aren't able to ensure that you'll get it back. And that's the inherent risk. The more that regulation clamps down, it pushes things into the shadows. We need more light and transparency to bring it to the forefront so that we can all use it and all benefit from it in a more transparent way, but also a way that is more scalable so that everybody has access. So what are your thoughts? Let me know in the comments below. Stick around to this channel for content like this. I love showing you guys what's happening in the world of finance, money, business, and crypto. So go ahead and smash that like button, consider subscribing, and I'll catch you next time.